Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update. The week is July the 15th, 2019. So starting with the market state, the S&P 500 is currently in market state 1, which means that long-term indicators, volatility, and short-term supply and demand indicators are all positive. Now, we primarily look at market states. We talk about the S&P 500, which is the largest 500 U.S. companies. But if we take a look at small cap and mid cap stocks, they have yet to reach new highs like the S&P 500. And then if we look internationally, like the EFA and emerging markets, they are far below their old highs from even January of 2018. So while the S&P 500 has had really strong performance, it's perhaps been one of the strongest indexes globally, and many other indexes really haven't seen the same amount of success. So then if we look at the Canterbury Volatility Index, which is again using the S&P 500, it currently measures CVI 56, which has been steadily declining since the market correction back in December. And then we saw a pullback in May and June, and then since that point it's kind of declined back to CVI 56. And to give you a better idea, I'll just take a couple look at some other indices here. The NASDAQ has a CVI of 80, the EFA has a CVI of 57, emerging markets is at CVI 73, and mid-cap stocks are at CVI 69, while small-cap stocks are at CVI 76. So mid-caps and small-caps, have a little bit higher volatility than, large-cap U.S. stocks. So if we take a look at the S&P 500, it last put in a new high, prior to today's high, back in September of 2018. Well, this really hasn't been the case, for many indexes globally, but I'll take a look at just U.S. ones here. So if we go back to the old high in September and then look at small cap stocks and mid cap stocks and compare them to the points that they're at today, well, they're nowhere near, putting in new highs, especially for small caps. So in the chart of small cap stocks, we can see it put in a new high back in September, but it's still 13% off of that new high, while large cap stocks have put in a new high. Mid-cap stocks are a little bit closer, about 5% off those old highs, but still have yet to experience the same levels of success that the S&P 500 has. So while the U.S. markets appear to be putting in all these different, new highs, not some of the smaller cap and mid-cap stocks have not experienced that same rally. So then if we get a little bit granular on the U.S. sectors, so the components of the S&P 500 being technology, discretionary, consumer staples, utilities, etc. We can rank those based on our volatility-weighted relative strength, which is a proprietary risk-adjusted metric utilized by Canterbury to rank different asset classes. And so currently the top ranked sectors are discretionary, technology, staples, utilities, and real estate. And each one of those sectors has actually surpassed its highs from last September, like the S&P 500 has. But if we look at the bottom half of those, so the next 5, which in this case would be industrials, communications, basic materials, financials, healthcare, and energy, they have not actually put in new highs. Then if we take the S&P 500 and actually put them into the ranking system, so compare the overall index against its components, the S&P 500 is actually ranked 3rd behind discretionary and technology. So what this says is, much of the performance of the S&P, much of the rally and strong performance has been from, heavier weighted sectors. So for example, technology makes up about 20-25% of the S&P 500's market capitalization. So it's, really carried the market upward to new highs. All that being said, all of the sectors except for energy are exhibiting bullish market characteristics. They just haven't experienced the same level of rally as necessarily the S&P 500, as many of the U.S. stocks have not experienced as given by small cap stocks and mid cap stocks. So bottom line, the market does remain bullish. The S&P 500 has been one of the stronger performing indexes this year, and then according to our sector rankings, discretionary, technology, utility, staples, and real estate are at the top of the S&P 500 sector rankings list, which is kind of odd to see. You wouldn't expect to see utilities and staples at the same level as discretionary and technology. So, in all this, it's important to remember that investing is a lifetime endeavor, and in order to achieve the benefits of long-term compounded returns, we have to be able to limit our drawdowns and rotate to those asset classes that are exhibiting bullish market characteristics. which the Canterbury Portfolio Thermostat and Adaptive Portfolio Strategy has the ability to do. Thank you, and have a great week.